the Fed doubling, tripling down on their rate hikes wrong?
I would have to say yes. And just this weekend, we found out why. So even though I'm an equity analyst at heart and a PM, I have to look at a whole bunch of stuff, right? And I have been watching the dollar march higher and wondering what it's going to break, because it didn't seem to be really helping us tremendously here as a consumer. So it had to break something. And over the last week or so, we saw the UK panic over their pension fund. And then Credit Suisse has credit default swaps going terribly wrong. And we can talk about the individual company, but what's really important is in pressing for yield, people went for these credit default swaps. And Credit Suisse isn't the only one that has probably derivatives that are not well managed, right? So what I don't think the Fed really truly understands is they can only control a couple of things, but the economy, especially the global economy, is more like a marionette where you pull one string and something goes horribly wrong.
But Kim, we're talking about the financial economy here, and the Fed is focused on the real economy. And this is the debate that everybody's having. Is financial stability going to knock the Fed off course as it tries to get inflation down in the real economy? And the Fed at the moment is saying, no, not so fast. In fact, those were the exact words used yesterday by one Fed speaker. They are focused on the real economy, not the financial economy.
Right, they are, but they are breaking the financial economy. So there is going to be a point, just like there was and I'm not saying that we're anywhere near what happened in 2008, but when banks and large banks, start crumbling, they're going to have to pay attention to what the dollar is doing. It's just that. And the dollar is going up because our interest rates are so high comparatively with the rest of the world. It's just that simple.
So, Kim, to that point, how do you approach earnings season that has to deal with a stronger dollar, this macro breaking potential issue, but then potentially solid numbers?
Right. Well, I mean, oddly enough, we still have a pretty good economy here, although there's some parts that are beginning to break down. We can see that. I'm somebody that is a growth at a reasonable price investor, so I'm playing the time game. I give myself longer than 12 months for my ideas to work out. And I like things like, and I know I'm going to get an eye roll from a lot of people, Intel and Coca-Cola, oddly enough. I think Intel can become a foundry like it wants to. There is a lot of impetus for foundries to be outside of the island of Taiwan for many reasons. And both Micron and Intel have begun building over here again. But I don't believe that's the only place they're going to build fabs. I think Ireland might be a good place. And there's other places around the world that people will build.
Aren't you just putting cyclicality into your portfolio if you put Intel or any of the chip companies in there?
No, not really. I mean, I was a software engineer. I believe in the power of tech, and I'm not just swinging for whenever the global economy comes back. I think that we're going to need a whole lot more chips because we don't have the people around to do what we need them to do, and we're going to replace people with technology, and technology always comes down to chips.
Why Intel specifically versus, say, other names? And the same thing for Coke. Like, why those names in the sectors that you're choosing?
Sure. So again, this is from my bias as an ex-software engineer. I generally try to look for companies that not only make technology, that's a good thing to put in your portfolio, but more importantly, to use technology well and to be able to do more with what they have. So that's what a good use of technology is. And believe it or not, Coca-Cola is a good user of technology. And you can see that on its earnings. So it can grow faster earnings than it can its top line, and that's what we're looking for.
Kim, how much cash have you got right now? Some of these names that you're talking about, these long-term opportunities, are getting cheaper and cheaper and cheaper. Are you holding back to invest at better prices?
I am. And I really hate to do this, but I'm dollar cost averaging, right? I'll buy either a third or a half of a position right now for new accounts. And I think it's paying off well. And on days like the last couple of days when things are up, I just kind of sit on my hands and don't do anything and see where things shake out. So I do think we're going to be on this crazy roller coaster ride of markets. And at individual stock levels, at least, we can pick up some good deals along the way.
Hey, Kim, what do you hate right now?
What do I hate right now? I always kind of hate REITs.
Fair.
I just do. And yeah.
But is that a specific yields are higher Fed economy thing, or is that like a Kim just doesn't like REITs? I'm trying to get a sense of like what you feel may not be investable at all in this environment.
Well, I think real estate, that's what I really don't like, in commercial real estate. With, Facebook cutting its presence in New York, and more people look like they're going to work from home for the rest of their lives if they push paper or electronic paper, whatever that is, right? So that's why I hate commercial real estate.
What's the flip side of that trade? If you hate commercial real estate, and people are working from home, what's the flip side of that trade?
Technology, baby, technology, because that's what makes working at home work.
It does. We've also bought an awful lot of computers and everything else over the last few years. Do you think we got enough?
Never, apparently. What I'm really interested in is Internet of Things. And I think that is going to drive exponentially the use of chips. And what that is going to do is make little devices that are out there measuring a whole bunch of things that would like to measure, and we can't right now.
Excellent. We're working from home, we're measuring things, we're drinking Coke.
Yeah.
Kim Forrest
Chips.
of Boca Capital Partners, thank you very much indeed. This is Bloomberg.
We have a Bloomberg exclusive for you involving Goldman Sachs. It's the latest filings in a class action lawsuit against the bank allege misconduct by managers at every level. Goldman fought very hard to conceal two names from appearing in the suit, and they're among the bank's most prominent men. Bloomberg's Siddhar Natarajan broke the story and has more. Sid, talk us through what we know.
Well, this has been a long-running lawsuit, a case that's been going on since 2005. And a couple of weeks ago, a filing dropped that showed pretty egregious behavior at Goldman Sachs from internal HR files at Goldman going back almost 2 decades. But what is interesting is it's not some of the most egregious stuff that caught all the attention that we're focusing on here. A clash erupted between Goldman and the plaintiffs over the last few months, specifically over complaints that weren't nearly as ugly as the worst ones here. But what raised the stakes there was the individuals involved, because they were two of Goldman's most prominent figures. One of them, Tucker York, who happens to run their consumer and wealth division, and the other is Gary Cohn, who was longtime co-president, then president at Goldman, and then went to join the Trump administration. Goldman aggressively adopted the stance that instead of people judging the complaints and deciding for what the complaints for what they are, they said that they were going to close ranks and put in a big effort to make sure that these names never became public.
Talk to me about the context of this. Talk to me about what is happening more broadly. Just tell me what the lawsuit, the original lawsuit, was actually about.
And that's an important question, Guy, because this lawsuit, like I said, the first seeds of this lawsuit was planted in 2005 by a Goldman executive, Christina Chen Oster. She had to wait until 2010 till she could even take Goldman to court. Now, almost 13 years later, the case finally goes to trial as one of the biggest class action lawsuits that deals with a case like this over equality, effectively over gender bias at the firm in terms of how they treated women when it came to pay and promotion. And these are arduous sagas. They take a lot of time. There have been some women who've dropped out of the class action. In fact, one of them, Jamie Fair Higgins, dropped out of the class to be able to write a book. And she wrote about her experience at Goldman Sachs, the 16, 17 years she spent there. And that actually became a rare tell-all from a high-ranking executive. We rarely have Goldman managing directors or anyone more senior than that writing a book about Wall Street in that fashion.
Quickly, what has Goldman's response been?
Well, they had argued in court, and they've told us the same thing, that they felt that including the name of the two individuals, Gary Cohn and Tucker York, was an unnecessary invasion into their privacy. They believe it is not central to the case, and they said these are unsworn hearsay complaints, and therefore people should never have been able to see who these complaints were lobbed against.
Shri, solid reporting as ever. Thank you very much indeed. Shri Natarajan. Thank you very much indeed. Markets just beginning to roll off a little bit now. Equities down, S&P down by 0.7%. This is Bloomberg.
All right, we're over an hour into the U.S. trading session. We got some jobs data that showed that we're seeing some loosening in the labor market, and equities now taking a leg lower. S&P up by 0.9%. Abigail Doolittle's tracking those moves. Abigail.
Well, Alex, we are looking at a second down day in a row. That S&P 500 near session lows, as you were just indicating. The Nasdaq 100 down sharply, and then even greater losses for China tech. So that weakness for some of those ADRs, such as Alibaba, JD.com, Pinduoduo, seems to be bleeding into U.S. tech. And then, interestingly, we have the conundrum of the year. Even though yields are higher on the day, pressuring stocks overall, especially technology, banks not benefiting. Now, relative to the sector composition, last time I looked, most sectors were lower. There were a couple higher. At this point, though, I think that we are probably going to have more sectors lower. Let's take a look at the Bloomberg IMAP, and we will see, I believe, yes, most sectors are lower. Energy, this is sort of interesting because oil basically right around flat, at least again, the last time I looked. Markets are moving so quickly recently, but you can see energy, the one up sector, similar to the year, up about 0.5%. The rest of the sectors down, and the bulk of them by more than 1%. Utilities, real estate, and financials on bottom. Interestingly, because with yields higher, typically that would press utilities and real estate, but it would actually help financials. Again, that is not happening. And here is this massive move higher over the last year for the 2-year yield right now around 420 or so. Again, that repricing of risk, valuation really weighing. However, it's interesting, Guy, because if we take a look at what's going on in the week, the last 2 days, today and yesterday, they feel as though they've been pretty bearish. But, you know, if we put them in the context of Monday and Tuesday, what had been the best rally since April of 2020, well, Guy, we are now looking at the best rally since June of this year. So will the bulls, the dip buyers, I'm not sure what you call them now that Fed put's not in place, but will they reemerge? They may, and again, make this one of the better weeks that we've had in quite some time for stocks.
Yeah, it's coming off some fairly bad ones, and we're about to go into reporting season. Plus, we've got to get through payrolls. There are a few little headwinds that we need to bear in mind. Abigail, as ever, thank you very much indeed. Abigail Doolittle on what's happening with the markets. Let's get back to the question of the Fed. The Fed and its officials, FOMC members, keep repeating the mantra that they don't plan to cut interest rates next year. San Francisco Fed President Mary Daly, Atlanta Fed President Raphael Bostic, the latest to bang the drum on the need to keep tightening in place, in order to reduce inflation, which of course leads us to our question of the day. Is the market right? And is the Fed wrong? Joining us now is Thomas Simons, senior economist at Jefferies. Thomas, let's get an answer on this one. Is the market right, i.e. we're pricing cuts for 2023, or is the Fed right?
Well, I think the Fed is right at this point because there are a number of reasons to believe that inflation is really a persistent problem that hasn't been tackled yet at all. And I think next week or the week after, when we get this upcoming CPI report, we're going to see a pretty surprising high print on core CPI that, again, is going to show that the leading indicators for inflation are still pointing up rather than down. And when you look at the strength of the labor market, I know that there's a couple of data points that we've gotten in the last few days that are starting to show perhaps the first sort of signs that things are starting to weaken a little bit. We're not even nearly at a point with the labor market where we're going to get persistent downward pressure with inflation. It's going to take several more months. It's going to take several more months of higher interest rates. And at this point, the Fed is not really, capable of stopping the rate hikes in time to anticipate that turnaround. I think that the market puts a lot of credit towards the Fed's ability to do that, sort of anticipatory pivot that just isn't really within their toolkit.
Well, Thomas, to that point, though, you mentioned the softening and loosening we've seen in the labor market. How quickly, though, can the labor market re-rate? I mean, is it possible that, last month was okay, this month is okay, and the next month, all of a sudden, we really start to see a down move in the labor market?
Sure. I mean, anything is possible. And clearly, I think something like what we saw with the JOLTS job openings earlier this week, that's, in my eyes, a sign that employers are looking towards what's in the outlook based on what the Fed has said about their forecasts for the economy and also just their forecast for interest rates. And they anticipate a downturn is coming. So there are going to be fewer hiring plans than there were 6 months ago, say, that could manifest itself in significantly slower job growth. But at this point, I think, we see a number of other indicators that suggest that for as many employers that are pulling back on that, there's still plenty that are looking to scoop up anyone who's lost a job or still looking to add to headcount. So I do think that it's not so much a 2 to 3 month time horizon before we see the labor market really start to turn around. I think it's well into next year before something like that happens.
Before that happens, are we going to see such significant financial instability, and we've seen some of that in the UK over the last few days, that the Fed is forced to change direction? In terms of the weighting that the Fed kind of has at the moment, financial stability, inflation, how does that balance work?
So I think we just heard from Minneapolis Fed President Kashkari today that said that financial conditions need to worsen very significantly before, from here, before they're going to start to weigh into the Fed's calculus on rates. I don't foresee anything similar to what we saw in the UK happening in the US. That was really a product of a really unique situation where monetary and fiscal policy were at odds. And as much as Congress can do, they're unpredictable, and certainly heading into election cycles, they may be, more willing to do looser sort of fiscal policy. I don't think that we're going to be so diametrically opposed that we have so much uncertainty about monetary policy that causes all that, market volatility.
But aside from market volatility, where are we seeing some liquidity issues, right? I mean, I've been reading a lot about global foreign currency reserves are getting really tight here. We're looking at illiquidity in the Treasury market. I feel like every other article I read is that.
Yeah, there are definitely some signs of cracking. And I think that, when we're looking at what happened last week, you have to also remember that we're looking at it in the context of heading into quarter end on September 30th, right? Like liquidity always dries up sort of towards the end of September. I think it's probably a little bit too early to sort of tell what's going on here in October. I'm not saying that it's getting dramatically better, but, there are bits and pieces where there are, some signs that things are not functioning quite as clearly, but also, you have to look at what's going on in the front end of the curve too. The Fed still takes in over $2 trillion in participation in the overnight reverse repo facilities. That's just cash that's floating around the system that's created by the sort of cumulative effects of all their bond purchases for the last couple of years. Before that, we really need to see that sort of thing to dry up before we would worry about broader problems with liquidity.
Thomas, if there were liquidity issues, would QT be the first thing to go?
I think so. I think that would be the easiest way for, at least for the Fed to sort of calm the markets, because there is definitely a lot of concern about QT that has sort of only barely gotten going. And yet there are evidence, bits and pieces of evidence that the liquidity issues are mounting. So, we've really only had, I think it's just September where they finally hit the full pace of QT. Walking back on that, I think would at least provide a good psychological signal to the market.
Hey, Thomas, thanks a lot. We really appreciate it. Thomas Simmons, senior economist over at Jefferies. Just to point out, we're seeing the sell-off in the bond market really pick up some steam, particularly over in the UK. You have long ends up by about 20 basis points. Also the dollar around the highs of the session as well. All right, coming up. What's the White House's plan B when it comes to oil? Amos Hochstein, the special presidential coordinator for global infrastructure and energy security, on how the White House is reacting to that OPEC Plus production cuts. President Biden said he was not happy about it. So what are we going to do? This is Bloomberg. President Biden saying he is disappointed with the decision by OPEC Plus to cut oil production. He says the U.S. is looking at alternatives it may have in response. Let's get to some of those alternatives now with Amos Hochstein, Special Presidential Coordinator for Global Infrastructure and Energy Security, plus Bloomberg Washington correspondent Emery Hordern is with us as well. Amos, I'm going to start here. Plan B. I've seen lots of different Plan Bs floating around here. What's 1, 2, and 3 on your list right now?
Well, first, let me just first, great to be with you. Thanks you, Alex and Anne-Marie, to be back on Bloomberg. Look, let me just stress where we are today. We were very disappointed in the decision by OPEC and Russia yesterday. We think it was a mistake. One, it's not substantiated by energy markets, by the global economy, or by any other metric. It was unnecessary at this time. Prices are already elevated. There was no real imminent threat of a major collapse in prices that would necessitate a cut. I understand that, having watched OPEC for a long time, there's a difference between what they announce and what they actually do. OPEC's quotas they're underproducing their quotas by more than the 2 million barrel cut that they've announced. So let's see if this actually has any impact whatsoever in actual production numbers.
Right.
We are going to continue to work at home and with our allies.
So,
one, we're going to work with our U.S. companies to ensure that they continue to increase production and make sure that we have the refining capacity. We're down a couple refineries due to some accidents and maintenance to make sure that we have enough inventory along the East Coast and parts of the Midwest and the West Coast to make sure that we have supplies. And we're going to continue to focus on bringing down prices. And to that end, we have still some work to do on the SPR.
Okay, Amos, there's a lot to unpack there. One of the reasons that OPEC talked about doing this was, in essence, to incentivize spare capacity. Higher oil price now to get more oil out of the ground, because if not, it's going to stay in the ground and there will be a shortage. If there is some truth to that, why not take that view with U.S. producers? Why go to your allies? We have oil here that we can get out. Why not pick up the phone to oil production companies and say, guys, what can we do to get you to produce more?
Alex, there's an assumption based in your question that we're not doing that. Even publicly, for the last several months, we have had conversations with the leadership of almost every major oil producer in the United States, told them, what do you need to be incentivized to increase production? We've had that honest conversation. They have what they need. They do not need anything else. I've had this conversation with them.
But I think, honestly, if we talk to the industry, they would point out that it's the threat of regulation down the road that's the issue.
Alex, I take issue with that.
Okay.
I don't think that that's actually accurate. I think, in fact, if you look at where it's always about where you put your money. CapEx has increased among the major producers in the United States this year. They're increasing production. They announced those increases in CapEx just several months ago, but it takes time for that to materialize in production. We've seen them increase production. We know that the projection is for them to increase production into 2023, the first couple of quarters of 2023. They have what they need. Rhetoric aside, I think they have what they need. They're doing that. We're calling on them to continue to do that. We have a good discussion with them. We don't always agree. That is true. And you know that this administration believes in accelerating the energy transition. But we do agree that in order to accelerate the energy transition, we need to have a functioning U.S. economy and global economy, and for that we still need oil production to rise in the United States.
Yeah.
That's what we're talking to them about, and I think that's where we're going.
Amos, okay, so to that point, can you basically play the forward curve like the Saudis are, in essence? Can you drain your SPR now and promise to buy certain oil from oil producers in the U.S. 6 to 9 months when that production comes online? I feel like that would give the market a lot of certainty. That would give oil producers a lot of certainty.
Well, let me be very clear. I said this before several months ago. We haven't said it in a while, but let me be very, very clear. Our intention is that when prices come down, we will be replenishing the SPR. We've always said that from the beginning, and we've told that, to your point, we've said that to the industry, that there will be repurchasing, because what we really care about is the economic security of the United States and the national security of the United States. And to do that, we have to have a well-supplied strategic petroleum reserve that we can deploy at times of emergency. So that we are going to be replenishing that. But the president announced a 180 million barrel release over a period of 6 months. It's been more than 6 months, but we haven't actually released the full 180 million barrels. So we are going to continue to do that. We're going to do 10 million barrels next month, and we're going to see what we need to do moving forward. So we're going to take a multitude of steps with the private sector in the United States, with our allies, with the SPR, and we're going to talk to Congress about what kind of tools we may need. We're not quite sure what we need, but we're going to have that conversation to make sure we have every tool available to us to make sure that American consumers continue to see the reduced prices of energy. I want to remind everybody before the hyperbole about yesterday's decision that oil prices are $30 down from their highs, and gasoline prices are $1.30 down from their highs.
Amos, I want to get a little bit into how we got here. You were in Saudi Arabia with the White House's Brett McGurk. This was reported by the Saudi State News Agency just less than 2 weeks ago. You met with the Crown Prince, Mohammed bin Salman. Did you walk away from that meeting thinking we'd be here today with OPEC Plus cutting 2 million barrels off the market?
I was there 2 weeks, around just about 2 weeks ago. No, I did not. I'm not going to go into the details of our conversation. They covered.
But no, you did not think there would be this big of a cut.
No, I did not.
What did you walk away thinking then from that meeting, that conversation with the Crown Prince? Obviously, energy was discussed.
Well, energy was one of the topics we discussed, and what I can tell you is I did not walk away with that understanding. But that was 2 weeks ago. I guess a lot can happen in 2 weeks in the global markets. Look, Anne-Marie, I think that the important piece here is to understand what impact this has. And this probably has a muted impact on the United States as we are a dominant energy country, whether it's oil or gas or solar and wind and energy and clean technology. We are a very strong economy and a very strong country. But there are a lot of poor countries, low-income, developing countries who are reeling from high prices. And this action by OPEC yesterday is turning their back on those developing countries in support of the Russian, what is good for the Russian agenda at the moment to finance their failing military aggression in Ukraine.
So the sense I get from you, Amos, is that you walked away with a different picture of what the kingdom was going to be pushing at this OPEC meeting. People in your own party, they are not mincing words. Senator Chris Murphy, I thought the whole point of selling arms to the Gulf states, despite their human rights abuses, nonsensical Yemen war, working against U.S. interests in Libya, Sudan, etc., was that when an international crisis came, the Gulf could choose America over Russia and China. You were there with the president in July. This was a controversial trip for the president to make politically. Where does this relationship go from here?
So first, yes, I saw Senator Murphy's words. But let me be clear. As you said, I was with the president on that trip. Number one, the president raised human rights and raised the difficult issues with the Saudi leadership, because Joe Biden always raises the tough issues at the top of any meeting. And he stood up for our American values. So that trip was in no way, shape, or form to undermine that. But what we said before the trip, during the trip, and after the trip is that it was not about oil. We had a lot of strategic issues in national security areas that we thought we could advance, and the president is committed to advancing America's national security interests. Those included integrating Israel further into the Arab world with the overflights that we were able to achieve then, moving Iraq away from the influence of Iran and to integrate them economically and from an energy perspective into the rest of the region. So there were a lot of reasons for that trip. And in fact, when we announced that trip, oil prices were $117 a barrel. And today, WTI is still at, I don't know where they are today, but about $87 or $88. That is a $30 decline. Gasoline prices, when we announced the trip, were at $5. Today, most Americans are at $3.29. The average, obviously skewed by a handful of high prices. So we're still at significantly lower prices.
Right, and WTI this morning is trading just under $89 a barrel, $88.65 according to my Bloomberg terminal. But the point is, you made this historic trip. The president said more oil would be coming down the pipeline. The meeting right after that trip, you got 100,000 barrels That's it. It was embarrassingly low. Now they're cutting $2 million. Just one question very quickly. Yesterday, Brian Deese and Jake Sullivan put out a statement, and there was a nod toward NOPEC legislation, which basically means the Department of Justice could sue these countries. In May, the White House had their concerns. Is this a signal that if this landed on the president's desk, he would sign it?
I'll let you do the tea leaf reading of the statement. I think we were both Jake Sullivan and Brian Deese were clear that we're going to work with Congress to see what kind of tools we need to make sure that the United States economy is strong and has what it needs and is safe from a handful of countries sometimes making decisions. We want to be able to make, the U.S. will make decisions for itself and what affects our economy, and that's what we're going to continue to do. So I'll let you read the tea leaves, and we'll see what actions we take over the next so months. The immediate actions are going to be to make sure the prices continue to be stable and to make sure they don't rise for American consumers.
Amos, thanks a lot. We really appreciate you spending time with us today. Amos Hochstein, a special presidential coordinator for global infrastructure and energy security. Anne-Marie, thanks a lot, and good to see you as well. All right, let's take a deeper dive here and speak to Kevin Book, Clearview Energy Partners co-founder, managing director. Kevin, you heard that interview. Your takeaway here on what the U.S. has to do.
Well, it doesn't sound like the White House is happy, but it doesn't sound like they have a lot of tools. You ended the interview with a discussion about the No Oil Producing and Exporting Cartels Act, which would allow the U.S. to sue producers under the Sherman antitrust law. And that's a pretty big weapon. To say that they're looking at Congress to tools seemed like a pretty clear reference to NOPEC.
Saudi Arabia is an ally of the United States when it comes to energy.
Well, we have an allied relationship when it comes to a lot of things. I think if you looked at the last several months, it would be hard to conclude that the kingdom believes that it is in its interest or in the economic interest of the world to continue producing as the White House is asking. But that's clearly not what the White House thinks.
So if the White House, so let's say we move on with OPEC, NOPEC, et cetera. Where else is the U.S. supposed to go?
Well, so we have domestic production, and I think Amos was busy talking to a lot of producers in a lot of places, and he made the point that the U.S. is still talking to the oil patch here at home. I think those signals are important, and the dialogue maybe didn't start out on the right foot. It's a lot to pivot, as the Biden administration has, from the greenest agenda in history to what Amos just said, which is working to increase domestic production. But I do think the messaging is changing.
Is it changing fast enough? This is a situation that needs resolving right now. The U.S., in many ways, has the potential to up its production of oil relatively quickly. I appreciate there are some supply chain issues. I appreciate that there's a shortage of various things like sand. But nevertheless, this is something that the U.S. can do relatively quickly if the policy message was there. Why is it not happening if that is the message, as we've just been hearing, coming from the White House?
Well, I think it's a question for producers themselves, but they do have a desire to run a profitable and sustainable business, which, if you go back to the old expectations for shale, that it would run without looking first. Those don't apply anymore.
Okay, so Kevin, if the conversation is turning a little bit, in the meantime, I'm wondering if you're going to see a thaw with Iran and a thaw with Venezuela.
Well, we're already seeing the signs of the thaw with Venezuela. That process began March 5th with the trip to Caracas. The prisoner swap over the weekend took it further. I think there's a real likelihood that they'll announce a resumption of talks in Mexico City between the Venezuelan opposition and the Maduro regime. That could be the trigger point for changing the sanctions that allow Chevron and other companies to get back in there.
Kevin, too short. Thanks very much indeed for your time. Kevin Book, Clearview Energy Partners co-founder and managing director. Let's take a look at where European markets are. We're heading into the close right now. We are softer. We're down by around 0.8% on the FTSE. CAC down around 0.7%. US markets beginning to stabilize a little bit. But the European close is coming up next. We're going to get an assessment of what comes next from a policy point of view. We've got the ECB and the Bank of England absolutely front and center. You've had a fairly big move today, as you can see, 18 basis point move on a UK 10-year, got an even bigger one on the 30-year. The Bank of England is under pressure. Laura Cooper is going to be joining us next. We'll talk about what the policy formula is going to look like here in Europe and how different that could be compared with the Fed. That's next. This is Bloomberg. Thursday, the 6th of October, European stocks head south, utilities doing the damage. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So European stocks are lower. We're trading 396. We're down by around 0.6%. Utilities, I say, are down. You've also got an effect coming through from Shell, which is a real heavyweight, guiding lower in a number of divisions today. That stock under a little bit of pressure. What is also interesting going into payrolls tomorrow is that we have a stronger dollar. So the pound is down. You've got a big move once again at the back end of the gilt curve today. Keep an eye on that. The Bank of England certainly will be. So the pound is down by 1.1%. You've got a meeting today with the Chancellor as well, with leading figures from the City of London when it comes to what is happening with the mortgage market. Then you've got euro dollar as well, heading south too. We'll talk about what's happening with the energy story with Europe in a moment, but certainly the currency once again under pressure, which makes that more difficult. We're trading spot 98.41, Alex.
All right, here in the U.S., S&P is off the lows of the session, and off the highs, I should say. S&P Energy Index, the one index that's really in the green. You have oil trading around $90 a barrel. Goldman says that if we have to rely on any kind of demand destruction for oil, the upside could be as much as $30. So the energy index doing well. And otherwise, it's a similar story from across the pond. You've got yields higher, dollar higher. Sell-off in the bond market, really the belly in the 10-year as well. How much positioning are you going to want to take into Jobs Friday tomorrow? Increasingly, you get the job cuts, the challenge of job cuts number rising, claims rising, a bit of a loosening in the labor market so that U3 rate tomorrow becomes all the more important, and the dollar yet another record high over the last couple days as well, Guy.
Let's talk about the politics here in Europe. The dollar is front and center right now, which I think is really interesting. This as European leaders try and figure out the energy challenge. They're also trying, I think, to maybe figure out a way that they can work together more effectively. The leaders of 44 European countries meeting in Prague today. The nations are trying to produce a united stand, of course, against Russia's war on Ukraine. The Estonian Prime Minister, Kallas, emphasizing the importance of a Russian price cap in that fight.
We have to understand that when we talk about overall gas or price cap, then we have to understand that the security of supply is also of importance, so that we will have gas, LNG coming from other parts of world.
The Estonian Prime Minister speaking a little earlier. Let's go to Prague, to that summit. There we find, of course, Bloomberg's Maria Tadeo. Maria, I want to start actually talking about the cap. So let's just focus on that gas cap, that energy cap. Do we yet have enough details to have a good idea of how it's really going to work? And if we don't, when are we going to get them?
No, we don't. And Guy, this is the fundamental problem. You have a growing number of countries now that say they want to see this cap being enacted. The European Commission now responding to that. Overnight, the head of the commissioners of von der Leyen actually wrote a letter to the heads of the 27 countries saying she's now willing to explore this option. But the fundamental issue, Guy, is that when we talk about a price cap, I can tell you at least 5 different options on the table. Is this just Russian gas? Is it all imported gas? Will there be side deals with countries like Algeria, Norway to negotiate a lower price? Is this about separating the electricity and the gas that is used to make the electricity? And this is fundamentally the issue. They agree they want to see prices go down, but they can't agree on the magic formula that works for 27 different countries.
That is fair. I mean, I can't even agree with what my family's going to do, and there's only 3 of us, so I hear that. Also, we're taking a look at how much money that's going to cost. Any way you slice it, this is going to be a lot of money that has not yet been factored in. Is that the next level of the debate, is how they pay for it and in what capacity?
Look, I think at one point there will be a debate around what is a joint response to this European crisis. And you saw already some tensions playing out on the Monday, especially after Germany announced that 200 billion euro package. And by the way, I'm being told one of the issues here is not just the size of it, which is big, but it's also the fact that many felt Germany did not really inform them well ahead. So they were taken aback by the lack of communication. Now, the other big debate, of course, and it feeds into the price cap. There's a number of countries that believe to get through the winter, you need storage. You need, of course, a price that is not rocketing through the roof, but you also need demand destruction. And some worry that if there is a price cap, you could see issues in the supply, but also perhaps create a perverse incentive that actually works in detriment to demand destruction. So you see there's a full package here with many different elements, and it's difficult to get to a cohesive solution, and that is where European leaders are at today in the summit.
100%, and then you just push off that moment of reckoning with higher prices later. Maria, fantastic reporting. Thank you very much. Maria today joining us from on the ground there. Appreciate you joining us today. Let's get more on that outlook in Europe. We're joined by Laura Cooper, BlackRock Senior Macro Strategist for iShares EMEA. Laura, always good to see you. That's the backdrop for what the ECB has to do when they meet. Is the ECB going to be hiking the way that the market thinks or the way that they need to in light of all this?
Well, the ECB, certainly based on recent commentary, is keen to hike as aggressively as markets are currently pricing. They want to get that policy rate back into that restrictive territory. And the meeting minutes today that we did suggest that they still see that as a significant ways away. But the challenge is this is a continent that is now in recession, most likely. It really raises a key challenge for the ECB as to how they're going to continue to raise rates in this period of economic contraction.
The Eurozone can either have an energy crisis or it can have a fiscal crisis. It's going to be one or the other. Given those choices, how differently will the ECB react to one of those two crises? So you can have an energy crisis, they go through the roof, you get a lot of demand destruction, or you can have a fiscal crisis, BTPs blow out.
Well, I think certainly from the ECB's perspective, the likely way that they would be looking at this is their ability to actually intervene in the bond markets through their TPI, through those measures already in place. So that's probably the most effective way for them to target. If we look at an energy shock, that's clearly what's being played out now, and their capacity to actually curtail that inflation is quite limited. And I think that's why we are seeing the stagflation environment start to emerge.
So to that point, we talk a lot about here in the U.S. about the central bank pivot, right? Is the first bank to pivot going to have to be the ECB because there's a specific energy crisis and in some ways political crisis in certain areas as well? Is the ECB going to pivot first? And does that make, weirdly, European assets more attractive?
Well, I think when we kind of take a step back and look at the big three, so the Bank of England, the Fed, and the ECB, yes, it's most likely to be the case that the European Central Bank will pivot first, largely because we are starting to see that data deteriorate. Notably in those PMIs that we did have confirmed this week did suggest that the periphery is likely already in a recession. So eventually we do think that the ECB is going to focus on those growth concerns. Whereas we look, for example, in the Fed, we do think that at this point we aren't yet seeing meaningful signs of deterioration on the economic front to warrant that pivot. And certainly the Bank of England has already acknowledged that they do expect this steep recession in the UK. So it's not yet a catalyst at this point to actually enter into European assets, but certainly we are watching for those green shoots. But I don't think that's going to be a 2022 story.
What does the euro look like in that scenario?
It's a great question. And actually, if we think, this firmly entrenched dollar uptrend, it's really hard to see what the catalyst could be to actually have depreciation. And I think in our view, it's really the case so long as the Fed continues on this aggressive tightening cycle, we have yet to see meaningful slowing in terms of the inflation front. So that's likely going to provide another tailwind for the dollar. Overlay that with the still terms of trade shock feeding into Europe, there's this risk premium being baked into Euro USD that does suggest that it's really tilted more towards further downside from here.
Yeah, no, fair enough. One more in the U.S. for me. Is the U.S. the only clean shirt in a dirty laundry? My metaphors are so bad. I don't think that's the right metaphor, but you know what I'm saying. Do you have to be investing in the U.S. if you're putting any cash to work?
I think at this point, yes, you want to probably from an equity sleeve perspective, we do like the quality tilt in terms of U.S. equities, but that's not to say that U.S. is the only safe haven in this environment. Notably, if we look to some European assets, notably in that credit space, we can get quite attractive coupon income without actually taking much duration or credit risk. So I think there are ways to position in this environment, but it's really about being nimble, it's about being selective, and it's about choosing those quality companies that have that predictability of earnings, that margin resilience, and the ones that we suggest will have those strong cash flows going forward as we weather this economic storm.
You could argue that the Bank of England has already pivoted, but we'll have that debate in just a moment. We'll talk more about what's happening in the UK next. It's been a turbulent few days. Looks like it's going to continue as well. Laura's going to stick around from BlackRock to talk about how she sees that story developing. We'll do that next. This is Bloomberg.
August jobs were right on target.
Pretty much in line with what Wall Street expected. A Goldilocks jobs report.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Does this imply that central banks will blink?
They want to see a little bit more slack in this labor market.
I don't think the Fed wants to see unhappy people.
There is a lot of monetary contraction and austerity coming down the pipe.
The September jobs report, Friday on Bloomberg Television and Radio.
So the good news just keeps on coming for the UK economy and the Liz Truss government. Overnight, we've learned that we've got another effective rating downgrade. The rating stays the same, but we go to negative from stable. That's Fitch, the rating agency, warning that the government's new economic plan, could increase the nation's fiscal deficit. You've just got instability. I think that probably is the word of the month when it comes to the UK. Joe Mays, our UK government reporter, back from Birmingham, reporting on what happened there, joining us now. Joe, we've got rating downgrades effectively coming through. We've got a meeting today with the Chancellor and officials in the City of London from mortgage companies. The rearguard action that is being fought here by this government is proving to be effective, not effective. Do we know anything about that meeting? What came out of it?
Yeah, so the big question for Liz Truss is going into Parliament next week, will her MPs rally around her, or will we see more of those rebellions that we saw at the party conference in Birmingham? Because there are two big issues there. One is, can she push through a supply-side reform agenda which brings economic benefits which outweigh those increasing mortgage costs that you just described? And with that policy package, can she even get it through the House of Commons? Does she have the backing of her MPs? And what we saw over the last few days is that in many cases the answer is no. So she's a massive political and economic challenge to make a success of her premiership.
Hey, Joe, does that mean that she has to pass it in little pieces then, instead of trying to get the whole thing through?
Yes, she might have to scale back her ambition in terms of how aggressively she goes with that package. So, for example, on planning reform, that's an unpopular issue with Tory MPs who have rural seats. They don't want to see more building happening in their area, but that's what the UK economy probably needs to get going. So she might have to tone some things down to have any profits of success.
Joe, the party voted for Liz Truss, MPs didn't. If she can't get some of the key elements through, do you think MPs will support her? Do you think she could be facing some sort of leadership challenge here? I can't believe I'm saying this, but I've been reading articles talking about it over the last few days.
Yes, there's a non-negligible risk that the Tory MPs decide, if they're still way behind in the polls, why not roll the dice again? If it looks like certain electoral oblivion, why not try again and install a new leader perhaps to try and change things ahead of the next election, which is due by January 2025, so there is still some time. They might make that decision. For now, Liz Truss is looking okay, but things could quickly change.
Rishi Sunak warming up the engine. Joe, thank you very much indeed. Greatly appreciated. Bloomberg's Joe Mays on what is happening with UK politics. That political story obviously having a massive impact into UK markets over the last few days. Still with us, Laura Cooper of BlackRock. She's a senior macro strategist for iShares EMEA. Laura, looking at the lie of the land here in the UK, do we have, and just listening to what Joe was talking about, enough sense of where we're going politically to invest into this story?
I don't think that's quite the case just yet. And we are seeing the UK bond market once again under pressure today, largely because there is still this fiscal sustainability concern that investors have. So we need to see some clarity in terms of how are they going to get a stable debt to GDP ratio going forward to bring back some of this credibility to an economy that's already quite challenged by the broader uncertainty that we are seeing.
Laura, what would it take for the U.S. to be remotely investable at this point?
I think for the UK, I mean, certainly there are pockets of opportunity. We talked about the dollar's strength earlier. So if we look at the FTSE 100, for example, their exposure is actually a lot of foreign generated income. So that should actually provide a bit of a tailwind to the FTSE 100, notably as those companies have been derated because of their proximity to the UK. So there's a potential upside there. Apart from that, I mean, we are certainly underweight gilts at this juncture because this is still an elevated inflation environment. We are as well, still short the British pound. It's hard to have a conviction story for upside there. So still a very challenging dynamic.
How bad could the recession be here?
I mean, certainly we're penciling in multiple quarters of contraction. And if we look at what markets are currently pricing in for rate hikes, if the BOE were to follow through on that, we think that could trigger a deep, severe type of recession in the UK, largely through those interest rate sensitive sectors. But again, we don't think the Bank of England is going to be as aggressive as market tightening, raising rates to about that 5% mark by the end of this year, early next year. But that's still enough to prompt material damage to this economy, and that is needed likely to bring inflation back to their target.
Okay, so with that in mind, if the BOE can't go to the level they need to get to in order to get inflation down, but they will inflict enough pain in the economy before they have to do some kind of pivot, does that mean the UK is going to live with like 5% inflation for a while? And like, how does that make you rethink how to allocate?
Well, I certainly think mechanically we are going to see inflation come down. Yes, it's going to remain elevated and somewhat sticky over time, but we are still expecting that central banks across the U.S. and the U.K. and Europe are going to live with a degree of inflation in the sense that not going to get to those 2% targets before we see those types of dovish pivots in play. So when we think about portfolio allocations, we still want to have some of those inflation type of protections in. So, and I think the key thing that we're looking at right now is actually short duration credit, short duration rates, those ultra short kind of protection. So taking kind of a cash-like exposures in this defensive environment to try to get some yield pickup.
You're talking about sterling denominated. What does sterling do? Like, am I going to, if I put money into sterling money markets, if I put money into the really ultra short end of the sterling curve, what am I going to lose on the currency?
Yeah, I mean, it's a great question. I think the fact that we actually saw the recent rally in cable was actually a reason to put on further GBP shorts in this environment, because this is an economy that is already a current account deficit. That's a clear challenge. Overlay that with the terms of trade shock. The key pressure valve for that to incentivize those foreign flows to come back in will be a weaker currency. In turn, will require higher yields. So it's quite a tricky backdrop. But if you're looking at cash-like exposures in a very short time frame, the coupon is attractive. But of course, there's going to be risk involved in these allocations.
Ending on the BOE, but also maybe taking it out of central banks. The idea that you're going to have a central bank raising rates, but have to perform some kind of intervention into the bond market to offset higher yields in the back end, which you could argue is a transmission protection instrument that the ECB is also looking at. Do you think that that's what every central bank is going to have to deal with as they try and drain liquidity?
It certainly is going to be probably a key risk going forward and something that central banks are going to grapple with. So we just had recent PEP data come out from the ECB yesterday that did suggest in June and July there was this redistribution to the periphery. But we actually saw that come off somewhat surprisingly over the past couple of months, which does suggest probably two things. One, the ECB does have its credibility. But secondly, more to the medium-term point, what you're talking about is just in the sense that we're likely going to have less PEP smoothing going forward. Overlay that with the risk that the QT could actually be pulled forward from the end of 2024, and we are in an environment where sovereign yields could continue to widen further. The yield curves could steepen, notably in Europe. That's quite a challenging backdrop if we're not back into a robust type of growth environment with inflation under control.
I'm feeling so much better after this conversation.
Yeah, good luck,
honestly,
guys. Good luck.
Yeah. It's going well. It's going really well. The good news, as I say, just keeps on coming. Laura Cooper, thank you. Always a pleasure. Laura Cooper, BlackRock Senior Macro Strategist, EMEA, iShares. Thank you very much indeed. What are we going to talk about next? We're going to go back to the airline sector. The sale of Italy's state-controlled carrier, ITA Airways, which was Alitalia, to a group led by US fund Certarès Management, could still be signed by the end of the year. Yesterday I had a conversation with the CEO of the company, Fabio Lazzarini, at the World Aviation Festival. Some interesting comments in that. We're going to play some of it next. This is Bloomberg. So the World Aviation Festival in Amsterdam yesterday, I had the opportunity to speak with the new ITA CEO, Fabio Lazzarini, about launching this new airline. It's the old Alitalia, remember, and how work is going in terms of planning for the final sale of the business under the new Italian government.
It is true that we come with a strong heritage. We are completely disconnected from the old company, but it's true that most of the competencies that we have in the company are still coming from there. We believe we took the best out of that history, which at the end of the day has been on some areas, especially on safety, on regularity, it has been not a bad area. We took also the lessons learned from those experiences. Give you an example. In the very last days of Alitalia, Alitalia was running a fleet, a theoretical fleet of 180 aircraft. Few models of Embraers, few models of Airbus, few models of Boeing. With all the inefficiency related to such a small fleet, differentiated increments. We decided, and we put also the actions behind our decision to go for one single manufacturer. We selected Airbus. We have a complete fleet based on Airbus, even if we know the 220s. We are getting a complete fleet. Yeah. No, we already are on Airbus only. Okay, even the legacy aircraft that we took are Airbus only. We don't have any other provider in our fleet now.
Got a new government?
Soon.
Yeah, it's coming.
Absolutely.
Have you had any conversations with the new government? Does the new government have a different approach?
The new government, I mean, the parliament is meeting for the first time next week. So there's no parliament, there's no government. And again, the process of selling the company is at the government level. So for sure, I guess, there have been conversations between the current government and the possible future, because the future government in this moment is only on paper, about the future of the privatization. The political decision was taken by the former government in February this year. Now it's the structure of the Ministry of Finance executing that political decisions at the best of their knowledge, or the best of their effort. They identified the consortium with which to engage in the exclusive negotiation. As far as we know, they are progressing. We have been supporting the process, giving data, having sessions with the potential future owners.
ITA CEO Fabio Lazzarini at the World Aviation Festival in Amsterdam yesterday. We are going to see that new Italian government next week. The market is definitely paying attention. What are we paying attention to in the markets right now? European equities are off their lows, but we are still down on the day. The close is coming up next. This is Bloomberg. The Thursday close. European stocks are down, but they're off their lows. FTSE 100 is suffering more than most. The DAX is down by 0.3%. The CAC's down by, 0.7% as well. So the CAC 40 and the FTSE 100 pretty much neck and neck. Italy down a little bit more. The IBEX down a little bit more. Spain outperformed yesterday. Let's take a look at the session, show you what's happening here. We've come off some decent days of gains, so a little rollover maybe to be expected, but we're back below 400, 396. We're down by around 0.5%. We spent most of the day actually in negative territory, and we're just off session lows as we come through the close. The sector story, there's some real heavyweight moves today, so that has skewed things a little bit. But the car sector is higher, pretty much the only major sector to be up. Utilities are down, basic resources are down, insurance is down. I'm surprised energy is performing as well as it is today, given what we're talking about with Shell. But as you can see, the bulk of sectors are in negative territory today. You can see why Germany's outperforming, with the car sector doing what it's doing. Let's take a quick look at some individual stocks and just show you what is happening here. Credit Suisse, there's a bunch of interesting stories around Credit Suisse. JP Morgan's got a really interesting note out. Take a read of it, or at least the headlines of it, talking about how you should be valuing Credit Suisse right now. And they say the market currently on the shares that we've got priced at the moment at 419 coming through the close is undervaluing this company. You've also got another story that this management team is looking around basically for capital, external capital to invest into the iBank business, the advisory business, which could ultimately be spun off. So they're trying to figure out exactly how they finance these spin-offs in this smaller, shrunken down bank. So Credit Suisse up by nearly 2%. Bellway's fairly flat today. I'm keeping an eye on the UK house builders. Today we've seen UK 5-year fixed rate mortgages go through 6%. This is a huge blow, I would have thought, over the longer term for the housing sector, but there is still a shortage of supply, so it's going to be interesting to see how those two factors come together. Kwasi Kwarteng, the Chancellor, meeting with mortgage companies today. Haven't seen a readout from that meeting. Is that good news or bad news? And then we come, I think, to the main event for single stocks today. It is Shell. The stock down by 2.48% today. A little surprise, maybe a big surprise to some, in terms of the warning that was given today. Petrochemicals is maybe the margins are going to be down a little bit there. There's a whole range of other businesses as well that aren't maybe quite doing what people expected and delivering the outperformance that they have. I will just point out, though, that this stock, I think, is up by 45% off its lows earlier on this year. Couldn't keep going up at that ever-expanding rate, but I think it's interesting that the stock is only down by 2.48% today, Alex.
Yeah, it is. So let's get into that. Joining us from Ryan Shell is Bloomberg's Will Kennedy, Senior Executive Editor for Energy and Commodities. There's a couple questions to unpack with this, but I just want to start with the fundamental point. We're looking at negative margin of $27 per metric ton for the period for Shell for its chemical unit. Supply or demand issue?
I think it probably speaks to a demand issue. It may be a sign, as we wrote today, that Europe's industrial economy is weakening fast in the face of the energy crunch that's afflicting the region right now. Very expensive energy is definitely bearing down on Europe's industrial sector. And from looking at the Shell results today, that's feeding through into demand for basic materials like the chemicals that the oil major produces.
Refining margins, what's going on there?
Well, look, refining margins are still not bad. They were exceptional, so they were always going to come off a little bit. I mean, in the first half of the year, in the wake of the invasion of Ukraine, we saw refining margins like the world had never seen. So I think we should bear in mind that although they're weaker, by historical standards, they're still very, very good. Yeah.
So, Will, for Shell, they can take a hit like this. I mean, as Guy was pointing out, I mean, the stock is only down modestly. It had a huge, nice run over the last year. But are there smaller companies in this space that are really going to feel a pain? And how are they going to deal with it? Do they have to close? Do they have to go to the government for help?
Well, there are lots of chemical companies and companies in other basic materials like fertilizers, which we've written about, which are finding it very hard to operate at these gas prices. And I was speaking to one European energy executive today that said that, some chemicals companies are just shutting production because what they're making is uneconomical at the current gas and power prices that Europe is facing. And we can see that that's actually feeding through into gas demand. Gas demand is down by at least double-digit numbers in many parts of Europe, and it's because these businesses can't afford to operate at these prices.
Shell and BP and companies like that have trading arms that have been hugely successful. They will shield for bigger companies, maybe from some of the turbulence they're seeing in other divisions. How well are those companies, those parts of the business performing right now? They've done very well. Again, it's kind of, can they keep performing at these kinds of levels? What have we learned today?
It's an opaque business. I think we learned that their gas trading business didn't perform quite as well as it has done in previous quarters, but there's every reason to think that there are huge opportunities in these markets for oil and gas traders at Shell, BP and elsewhere. You're seeing disruptions to come. You think about the sanctions that are going to come in the start of the year. Now, obviously, Shell doesn't trade Russian oil anymore, but flows will be rearranged around the world, and those kind of events where Europe has to go elsewhere, where Russian crude has to go different places, where you're displacing crude flows, where you're displacing product flows, those are huge opportunities for traders.
Yeah, whether you're looking at oil or natural gas, etc. So, Will, if we look ahead then to earnings season, like what are some of the highlights that we're going to be expecting from the big guys?
Well, oil prices are back on the march again, and I think the OPEC decision yesterday could be very consequential for oil markets as we go through into the winter, and of course that makes them consequential for the oil majors. People were worried about oil prices dipping with the economy, and I think OPEC has made pretty clear they're going to put a floor under it, which is frankly good for the oil industry.
If we were to see Russia, because of the cap, reducing its supplies onto the global market, how big a hit would that actually be at this point, considering we're already seeing self-sanctioning and other restrictions in place?
Well, what's remarkable about what's happened since the war is that Russian production is down a bit, but not nearly as much as people thought. They have actually found a way to get that oil to places. That oil is going to India, it is going to China. I think the question is when these sanctions come in December and more oil has to be diverted to new customers, will they reach the limit of those diversions, or will there be a place where they just have to shut in some production? And I think that's going to be a very key consideration for the oil market over the next few months.
Fantastic coverage over the last few days, Will. Thank you to you and the team. Greatly appreciated. Bloomberg's Will Kennedy. A bit of news out of the Bank of Canada. Nuance is important. The Bank of Canada signalling it's not ready for a, quote, more finely balanced rate policy. The Bank of Canada says more will be done in curbing hot inflation. Again, that doesn't sound like a pivot. We've heard similar messages coming through thick and fast, Alex, from Fed officials over the last few days. UK markets, European markets just closing, little tick lower during the auction. We've come through the settlement, so we've done that now. The FTSE 100 finishing at 69.97. Make sure you carry on the conversation with Alex and I at the top of the hour.